Okay, welcome to the February 28th edition of the Fats, Fuels, and Oils webinar. A couple little pieces of housekeeping and then we'll get started. Sorry about the last couple of weeks. I'm having a computer issue with my Excel spreadsheets, and as a result of that issue, I haven't been able to update anything on the website. Opened up a ticket and the IT guys are working on it, but they don't seem to really understand what's going on, which is a little scary. Anyway, hopefully they'll get that fixed soon and we'll be back to normal. All right, with that, let's get going. Today, what we're going to talk about is the EIA data that just came out, and then I'm going to run through all of our veg oil forecasts for you, so at least you can see those. I wanted to get at least some of the fats and greases forecasts up too, but I ran out of time this morning. So I'll do those, and then hopefully the IT guys will get this fixed and everything will get updated and you'll be able to see those on there. If not, if there's one that you just really need, let me know. I'm happy to send it. Otherwise, hopefully things will be back to normal next week. And if not next week, I guess we'll cover fats and greases, but really hope that this doesn't continue into next week. All right, so the EIA released their monthly biofuel production and feedstock data today. And as you can see, production of renewable fuel, excluding ethanol, which isn't exclusively biodiesel and renewable diesel, it includes some other stuff. But generally, the EIA reported that was flat in December. Doesn't quite match up with the EMTS data. And I think probably more significantly, it never matches up with the EIA data, but more significantly is if you look over the last, since July, essentially, you can see combined production has been relatively flat, not the big ramp up that we saw last year or that we've typically seen. And you can see by our 2023 forecast that we're starting to adjust for that. Now, I probably am going to go back and make the 2023 July to December period a little flatter. So I probably will raise December a little bit, lower October a little bit, that kind of thing. But I think that that based on the EMTS data for January, which didn't show as much of a decline as we're used to seeing, it seems like we're switching from production that is really seasonal to production that isn't so seasonal. And I assume that as more of the production is renewable diesel, that trend will just kind of continue. The total for 2022 was 3.31 billion gallons. That was up from 253 billion the prior year, about a 770 million gallon increase year over year, which was about the same we saw from 2020 to 2021. 2020 obviously was impacted by the pandemic, and so that's a little less important. But I think the probably one of the more important things that the EIA reported was the capacity data. And so if you look at the change in biodiesel capacity from the beginning of 2022 to the end of 2022, it was down about 153 million gallons and still well over 2 billion gallons. Conversely, if you look at the renewable diesel capacity, That more than doubled. It was up by like 1.3 billion gallons, which I think it was 1.1 at the end of December. So I think generally the expansion of renewable diesel capacity, at least as reported by the EIA, fit with sort of what we were expecting for 2022. For 2023, the increase is slightly smaller, but for 2023, I think, and I've talked a little bit about this before, I think that increase is going to make it so that renewable diesel production, if you just go by the mandates, would be, or renewable diesel capacity utilization, if you just go by the volumes implied by the mandates, would be relatively low. And so we've raised our production forecasts above what the EPA's mandates imply to make it so that renewable diesel capacity utilization is closer to its historical average, although at least in 2023, it still is a little bit below its historical average. And then as you run forward in time, we get closer to that average and then even go a little bit above it as we start to rationalize biodiesel capacity. And in that rationalization of biodiesel capacity is the key to all of this kind of going forward, production levels, feedstock prices, all of that good stuff. If biodiesel capacity continues to hang around or even declines at 150 million gallons a year, then it's going to be based on the mandates for 23 to 25. We probably will be in the same situation for that entire period. Now, once we switch from the blender's tax credit to the Inflation Reduction Act credit, I think that's when you have a real chance to reduce biodiesel capacity. However, biodiesel producers are working to reduce their CI scores so that the impact of that is less than it would be if they didn't. And I think if you combine their efforts to do that with the profits that they've made in the last, call it 4, 5, 6 months, there probably is a chance that those profits will allow biodiesel producers to do things like carbon sequestration that will reduce their CI scores and allow them to stay around longer. Now, we still have, if you look at our 2024 biodiesel production forecast, we still have relatively aggressive decline in biodiesel capacity after the switch to the Inflation Reduction Act credit. But we are going to try and figure out how many of the biodiesel producers are going to be able to get their CI scores under 50, what those CI scores kind of look like, and then probably redo our estimates on biodiesel production going forward based on how successful they are essentially at lowering their CI score. If they don't, then we'll be much more aggressive. If they really lower their CI scores, then I think we're going to be faced with this problem of overcapacity for a while, at least until margins fall and are sustained at lower levels for an extended period of time. Because if you look at what the profitability, even simple measures of profitability like feedstock costs or like revenue from fuel sales minus feedstock costs without credits or even with credits, but just something really simple like that. What you saw in 2021 when feedstock prices take off is that biodiesel margins were negative, really negative compared to sort of where they had been historically. And so if biodiesel producer, if you didn't get a lot of capacity rationalization at that point, it probably means that they had the balance sheet to get through that period, and then they made a bunch of money. So their balance sheets, whatever they had to draw down on their balance sheet from that, they probably have rebuilt, and they'll spend some of that money on carbon sequestration and that kind of thing. But it could be that biodiesel capacity is much stickier than I have assumed this whole time. I've believed that biodiesel capacity would stick around for longer than kind of you would first think, but I've also, like I said, have been relatively aggressive about cutting biodiesel capacity after the switch over from or the switch over to the IRA credit. And it may be that I have to go back and reduce the aggressiveness of that of those cuts. And I've started to do that a little bit, but I would say that the changes that I've made so far are really, really minor compared to what I might need to do if I become convinced that the biodiesel industry or a significant portion of the bio industry will be able to operate and thrive in the new environment that comes with the Inflation Reduction Act tax credit. All right, so this is a calculation of yields based on the feedstock data from the EIA and then the EPA production data. You can see for whatever reason, there's yields are really high or really low. It takes a lot more feedstock to make biofuel in January, and that seems to be consistent for some reason. And then you get down to a level that it kind of makes sense. But if you think about, at least for the conversion factors that we have, soybean oil, we have at about 7.5 pounds per gallon. And you can see the average here, the 5-year average is about there. And so because soybean oil represents a large percent of the total feedstock, you would think, okay, well, 7.5, a little above 7.5 is fine. But fats and greases and other things that have conversion rates that are sometimes over 9 pounds per gallon for renewable diesel should lift this number up a little bit more than the implied yield. There is a difference between, obviously, the EIA and the EPA data. The EPA data is really blended, not necessarily produced in that month. I always call it production, mostly because we don't have another great source of production from the EPA. And I also assume that blending occurs on a relatively normal basis. And so even if, let's say, blending occurs 2 weeks later than production, but it's always 2 weeks, then it unless there are huge variations in production, it shouldn't really matter. That should translate into, it should all sort of even out in the end from month to month. You won't get the exact number, but it should be relatively close. And because of that, I can kind of accept, I guess, the difference in yields between what you see here and what I would expect. But it still isn't, they still aren't quite as high as they probably should be, again, at least based on the conversion factors that we're using. The average for 2022, just as you can see, is 7.65, but the range in January was 9.6, and it dropped down to 6.73, which really doesn't make a lot of sense in November. And the EIA reported feedstock use for 2022 was 23.25 billion pounds, which is up from 19.32 billion the prior year. That was a little bit below where we were expecting, mostly because we use higher yields or lower conversion rates than they actually work out to be. But that most impacts soybean oil, and so our soybean oil forecast was higher than our forecast was higher than the reported numbers. And I think that that as we continue to expand production and productive capacity, that as we start to get to the edge of fats and greases, the edge of their supply or their available supply, then having the yield come down a little bit to sort of these levels will start to make sense if soybean oil starts to account for 60% of total feedstock use. I'm not sure we ever get that high even as we go out to 2040, but we do start to need to use more soybean oil as we go forward. All right, so this is what it looks like if we compare the EIA feedstock data with the EIA production data. And so here, I think that, again, you see the 5-year average looks probably a little high, and then this year's numbers obviously look low, given that they're under our lowest yield. And you can see they have sort of worked their way lower as we move forward in time. This is probably because we are including additional fuel in the or additional fuel categories, stuff like naphtha, in the total fuel production, and naphtha is a byproduct. So you would expect these to be a little bit lower than what would be implied just by the conversion factors, but is probably still a little bit low. I think one of the things that I may start to do is try to figure out exactly what all is included in domestic renewable fuel, and then try to subtract the EPA data for those categories that aren't renewable diesel or biodiesel out of that total. And again, we'll have the sort of the mismatch issue, but then at least we'll be able to compare EIA feedstock data with what we think is actually EIA production. And I think ultimately that probably will be sort of the yield number that we tend to lean on the most. Right now, we kind of use our own, and we look at these for informational purposes, basically. And so we can see what the trend is during the year. But beyond that, I think both of these numbers are probably off by a little bit. And if you took kind of the average of the 5-year averages, that's probably where I would expect that the average yields should be. Oops. All right, so moving on from the EIA report to just talk about the cash markets and soybean oil prices for a little bit. So this chart just shows the round trip that we've made in RBD basis for Central Illinois. You can see in the first half of 2022, basis shot up. And then as we got into the second half of 2022, and then so far this quarter, we have erased all of those gains now and actually are about a half cent lower on basis than we were at the beginning of 2021 or 2022. I think one of the things that has happened, at least recently, is that while we've had this big expansion in renewable diesel capacity, what we haven't seen is a similar expansion in production. And again, if you look at the end of 2022, capacity utilization rates kind of came down from the average before that, not as low as what is implied by the mandates, but probably lower than I thought sort of 6 months ago or a year ago, or lower than I thought we would be 6 months or a year ago, given what the capacity number is. So if you told me this is the capacity, where do you think production is going to be in December 2023, 2022? It would have been significantly higher than the number that was reported. And part of that has been anecdotal reports that we've heard about some renewable diesel producers that are not able to get up to full capacity as quickly as I'm sure they want, and as quickly as we had assumed. And over the past month, but probably really since the Christmas break, which is when we really saw RVD basis start to come down, even though in Q4 it's a relatively small change. But over that time, we started to hear about some issues and some people being overbought. And so what that has done, I think, in soybean oil, it's kind of put a cap on prices. For the fats and greases, which typically sort of lag moves in soybean oil, it looks like over the past week or so, they've really started to catch down to where soybean oil is. And I think we'll see. But I think that flush down in the fats and greases may be the market working through the excess feedstock inventory. And once that stabilizes, which it could be this week, it could be next week, it could be, I don't think it's going to be, 6 months from now. I think it's probably, if it carries over into Q2, I would be a little bit surprised. But once we work through that, then I think you'll see fat and grease prices stabilize and then start to catch back up to oil. Now, soybean oil is trading around 60 cents-ish, a little bit above 60 cents-ish, a little bit. And it's tried to rally a little bit over the last couple of weeks, but it hasn't really been able to get up very much. And last week, most of the cash prices and soybean oil futures, I think, were down a couple of cents at least. So there is, soybean oil hasn't really been able to get up and go like you might expect if we are getting close to working through the excess inventory. That said, if you look at the soybean oil spreads, they've started to move higher again, at least in the deferred spreads. Now, the nearby spreads still feature some carry, but if you look out at the July-September spread, that has moved up from, call it 75 basis points to, I think it topped out at $1.50 at the end of last week, maybe. And then yesterday it was down a bit, but it looks like it stabilized today, or at least the last time I looked at it, it looked like it stabilized. I think that spread is probably the key to what prices are going to do in the second half of the year. We still have concerns about Argentina. Those are somewhat offset by amazing yields in the center west region of Brazil that's going to lift that crop probably above market expectations at the beginning of the year, and probably offset almost all or maybe even all, depending on how big the crop ends up being, of the losses in Argentina. So if you think about the losses in Argentina, if we say we started at 50 million tons in Argentina, 150 million tons in Brazil, Argentina probably is down 10 or 11 tons right now. And then Brazil is probably up 6 or 7 tons. So not quite completely offset, but the bulk of the decline in the Argentine crop has been offset by an increase in Brazil. If let's just say that it was completely offset by that, then our expectations for prices shouldn't change really, right? That is kind of true, except that there are a couple of issues. One, the timing of the Brazilian crop is generally a little bit earlier than the timing of the Argentinian crop. And so you would think that soybean oil would get to the ports and then out of the ports and to the export market earlier. But Brazil is kind of notorious for it taking a little while for the crop to go from harvest to the ports. And so there probably is going to be a little bit of a delay there. And there probably is going to be a period where the world market doesn't really have the supplies that it needs. And that period probably is going to be either late this spring or sometime in the summer. And how supportive that is to prices will depend a lot on how much of the Brazilian crop is crushed and then how much of the soybean oil from the Brazilian crop is exported. Brazil is trying to raise their biomass-based diesel mandate back to where it was sort of supposed to be before the pandemic. And so domestic demand in Brazil may be a little bit stronger than it has been over the last year and a half or so. And that may limit the amount of soybean oil that is available to the export market. For Argentina, I think if we stay around this level, if you're in between somewhere between 39 and 41 million tons, then I think that I haven't had to cut my crush forecast that much yet. But from here on out, I'm mostly going to cut my crush forecast. I've already cut exports down to a level that I think is about as low as soybean exports can go. And so any further reductions in the crop are just going to translate into reductions in crush, or mostly reductions in crush. I've taken the stocks down a bit too in Argentina. I don't know if that part will materialize given the Argentine farmers' preference to use soybeans as a hedge against economic uncertainty. But at this point, I don't really expect the impact on crush in Argentina to be as bad as the crop looks. Now, if you look at this morning's forecast, Argentina hasn't had a significant rain since like January 20th or 21st. And the forecast models now go into mid-March, and there isn't really any significant rain forecast during the next couple of weeks. The bulk of the Argentine crop is getting ready to go through pod setting and then pod filling. So there still is some time to recover. But if you've seen any pictures of the crop down there, it looks amazingly ugly. And while I always say that sort of the best way to produce big yields in soybeans is to stress the crop early and then give it lots of water while it's filling pods, there is a limit to how bad the crop can look when you start to set pods and fill pods, and how much yield you can recover. And based on at least the pictures I saw, which of course will be the worst pictures of any of the crops down there, but given the rainfall totals and the rainfall forecast, it wouldn't surprise me to see expectations for Argentinian production to come down a little bit more. And I think that combination, along with the idea that as we move into the second half of the year, renewable feedstock demand will be stronger than it is in the first half of the year, and potentially stronger than the market expects based on the mandates. You could have a really strong move in soybean oil futures and basis levels in the second half of the year. And so let's look at what we are expecting for some of those. So we'll start with Argentina. You can see we've got prices kind of up a little bit and then kind of moving back lower as we get more information about what the US crop looks like. So we kind of peak out in May or June, and then assuming that US planting goes well and the US growing season is good, then that starts to weigh on world prices, because even though the US isn't really as engaged with the world market as it has been in the past, our exports are obviously really low. It still will provide at least comfort to the market that if it absolutely needs veg oil supplies, that there is a place that it may be able to go if the US crop is a good crop. Now, whether they can actually ultimately get those supplies or not is sort of a different question. And if you and the other thing that is going to probably limit the upside, especially for Argentinian prices, is the fact that that the US or the world generally has enough vegetable oil right now. If the Argentine crush is reduced a lot from current expectations, things could look a lot different in a couple months from now. But unless that happens, or unless there's a problem with the US crop, it's hard for me to see where international prices will really rally strongly based on strong US domestic consumption, again, since we've already sort of pulled out of the export market. And just as a point that shows the difference between the US market and the world market, the spread between soybean oil in Argentina at export terminals and the US Gulf is almost 10 cents a pound. And that's at a time when Argentina has had 3 years of below average soybean production. And they are at the end of their marketing year. So that's the time when you typically have the least the smallest soybean stocks. And usually that's when prices are sort of best supported if there are any problems. And so while I can see the Argentine drought kind of helping support prices over the next couple of months, as we get the Brazilian crop in, and then as we get into the US planting season, assuming that goes well, again, it's hard for me to see world prices really kind of taking off unless China really comes back strongly and really needs a lot of soy or a lot of vegetable oil. But they've been importing canola from Canada. They're going to be able to import soybeans from Brazil. And so I don't think that we're going to see a repeat of this situation where China was really short vegetable oil and had to go to Brazil and buy a bunch of soybean oil. So this is the US Gulf price, and you can see it kind of generally follows the same pattern. It's a little bit, prices are a little bit better supported for longer. The down doesn't really come until we get to the US harvest. But this is the difference between the US domestic market and the world market. And the US Gulf price right now, I think, is it's not really indicative of anything in one sense, because there isn't really, we're not doing a lot of export business, and the world kind of assumes that soybean oil isn't available from the US. And so it's a price that's out there. It's a price that is, this is what it takes to get soybean oil out of the US domestic market. But not a lot of people are takers at that price. And so it's a price, but it's not a price that that I think the indications from this price had probably lost a lot of their importance given the reduction in US exports this year. All right, and then this is crude degummed for Central Illinois, and you can see it generally follows the same pattern as the Gulf. Maybe is a little bit better supported, and then kind of goes down after we harvest the U.S. crop and as we move into the next South American growing season, which we assume La Nina will be over. You've had a big expansion already this past year in Brazilian acreage. Everybody will assume that there will be a comeback in Argentine production. And so at that point, again, assuming a good US crop, it feels like soybean prices probably will move significantly lower, and then that will drag soybean oil prices down with it. RBD soybean oil is a little bit more extreme on the increase and the decrease, and that is a function of the idea that right now the problems that the renewable diesel producers have, and then the expansion of renewable diesel capacity, means that the demand for RBD is probably a little bit greater than it's going to be in the long term. If crush remains a little slower than expected in the U.S. and non-biofuel demand remains relatively strong, that's kind of what we're basing this rally, this 10-cent plus rally between now and late summer for RBD. If the renewable diesel producers get back to normal operations faster than we expect, and start to buy crude degummed instead of RBD, then I think this probably will look a little bit flatter, and crude degummed prices probably will take on more of this kind of steep shape. My expectation, and we've talked about this before, for RBD basis, again, if you think of RBD basis as crude basis plus a refining margin, my expectations had been that what we would see is, as renewable diesel capacity expanded and pretreatment got up and running, that switch from RBD demand to crude demand would narrow the refining margin and expand the crude basis. And of course, what has happened over the last, again, sort of since the Christmas break, or maybe a little bit before that, is almost the exact opposite, with I think crude basis for Central Illinois around 2 cents right now, and the refining margin really supporting the RBD basis. And so the refining margin, I think, is like 8 cents or 9 cents. That's in one of these slides. And that has been stickier than I thought it would be. There's a spot between sort of 7 cents and 10 cents where RBD basis or the refining margin has found some support over the last 6 months, or since it really took off in April 2021. And that seems to be the comfort level. But again, I think that is a little distorted right now, because you're not seeing as much demand from the renewable diesel producers for crude as I thought there would be at this point. And you have this overhang of fats and greases that probably also is reducing crude demand to the extent that refiners can get fats and greases that'll prefer that over crude or RBD, really. Beyond the expansion in renewable diesel capacity and this idea that the biomass-based diesel industry might need to overproduce, probably the most important thing for RBD soybean oil prices over the next 6 months or year will be the strength of the U.S. consumer and the U.S. Economy. I think that coming into the year, even though the Fed was raising rates, the consumer had enough extra savings from the pandemic that expectations for 2023 were, yeah, there's going to be a recession at some point. Maybe it'll be a little bit mild because the Fed is raising rates. But it's probably not going to be that bad. And non-biofuel usage is going to be about where it was last year. And now what we're hearing from some people in the non-biofuel industries are that that they think demand could potentially be a little bit weaker than they thought earlier, at least in the relatively short term. And if you look at sort of the US savings rate or credit card debt or any sort of representation of the economic health of the US consumer, those things are starting to deteriorate. I don't think any of them are sort of flashing red, but they probably aren't quite as good as people thought they were 6 months ago. And I think that the idea that we're going to have a recession is now sort of divided into two camps, where one is consumers going to run out of money and it's going to be bad to maybe really bad. And the other is that as China comes back, Europe is coming back, that will be enough to kind of help offset whatever weakness there is in the US consumer and keep the recession relatively mild if we really get into it at all. And if you look at the labor market, that's probably the strongest indicator of that lighter recession sort of theory. And that's kind of what we're trying to go with right now in terms of our outlook for non-biofuel and our soybean oil balance sheet. We'll see what happens in the next couple of months. One of the things that I would note is that if you look at food spending at home and away from home, you look at that combined total in constant dollars, you did see a peak last year, and then it's come down relatively significantly, especially in the during the holiday season. So typically you kind of see it go up into the summer and then kind of go down and then sort of move back up again a little bit in the in November and December as people have friends and family over and spend more money on food at home. In this year, you didn't really see that. In fact, in November and December, I would say that that total expenditures were substantially below where you would expect them just based on the seasonal pattern. And if that is an indication of where the consumer actually is, given these other things outside of employment, then maybe it's going to be bad to really bad camp is correct. We'll see what happens in the next food spending at home and away from home release, if that continues. And I would also say that there is some chance that reduction in constant dollars is just an effect of there's a lot of inflation and consumers are watching their food budgets much more closely. And so maybe they're spending the same amount that they spent on food. Let's say they spent $200 a month. Anybody that has kids, I'm sure that sounds like a ridiculously low number to you, but let's just make the math easy. Let's say that they spent $200 a month, and then inflation would take that same basket of goods up to $215 or something like that. In that case, then it may be that they're still essentially spending $200 a month and maybe buying just a little bit less, but the inflation numbers are big. And so if you adjust it back to constant dollars, it decreases the spending more than the actual sort of food consumption, food production and consumption. I don't know that that's true, but that's one explanation for what happened in November and December that that may ultimately be what I come back and say when the recession isn't that bad and food spending doesn't really continue to move lower. It just kind of goes sideways or starts to go back up again. Okay, so then canola oil. Canola oil looks a lot like soybean oil, and the spread there, you see the average monthly spread for the forecast period is 5.4 cents. And that is just above what we estimate the cost to transport vegetable oil from central Illinois to Los Angeles is. Even if our freight estimates are off, either higher or lower, I don't think that they're off by 5 cents. And so what that means is canola oil remains relatively close to parity to soybean oil. One of the interesting things in the EIA feedstock data was canola oil usage. So the EPA approved the RIN pathway for canola oil in renewable diesel, or to generate RINs from renewable diesel production in December. And we had heard that there were renewable diesel producers that were buying canola oil ahead of that decision. They knew it was coming, and canola oil was about at parity with soybean oil back in the fall. And so they took advantage of that. And then it looks like, again, based on the EIA data, that usage was, I think they reported usage to 170 million pounds, which is up from, I would have called it probably the average for the several months before that, around 140 million pounds. So that gives us a little bit of indication of how much soybean or how much canola oil is going to be used in renewable diesel production, except one, the EIA is reporting for December. And so that was only a partial month, and it was included the holidays. And so that's going to reduce whatever that is. However, on the other side of that is that given the competitiveness of canola oil, it worked probably in a lot more locations than it's going to in the long term. And so while that sort of 30 million pounds of additional demand, call it, is probably reduced by the fact that it's only not all of the month and the holidays are in there and that kind of thing. It's probably also increased by the fact that people were anticipating this and bought canola, and canola oil was competitive. Now, since then, we've had a little bit of a move higher in the spread, but then the spread is essentially, again, like I said, come back down to parity. I think that if you look at the forecast, the 5.5 cents essentially is the average for the year. If you look at the forecast, we expect that canola oil will remain competitive with soybean oil for the next couple of months, and then the spread will start to widen back out towards its long-term historical average, which is around maybe 15 cents, depending on exactly what you're looking at, maybe a little bit lower than that. And I think that canola oil, ultimately, probably that spread widens back out, because as more canola oil is used for renewable diesel, and as more soybean oil is used in biofuel production period, the non-biofuel industries, particularly the food industry, are going to need canola oil to substitute for soybean oil. And while there are some things that are really in vegetable oil intensive, like mayonnaise or salad dressing, for most products, the cost of the vegetable oil in the product is not nothing, but certainly it's doubled, let's say, in the past couple of years, but it's doubled from 0.5 cents to a penny in total cost for a lot of products. And so I think that the food industry will get really competitive with the biofuel industry. And I think that's something that's a fight that they're ultimately going to win in terms of supply. And so you get the spread to widen back out. And then canola oil makes sense in the places where it is more available just because of geography than anything else. And so that's the West Coast of the US and then the Rocky Mountain region essentially in the US, and then maybe a little bit of the northern plains, sort of upper Midwest, that area. I could see it being used there, but again, I think once things start to really tighten up, then and the food companies really need to secure canola oil supplies, I think that's when the spread really starts to widen back out. And I think that happens sort of closer to the end of 2023, again, depending on what the US soybean crop looks like and the US and Canadian canola crops look like. Assuming everything is okay and just kind of going forward, that's kind of when I expect that this will happen. You'll see feedstock demand pick up in the second half, and then by the time we get to the end of the second half, we probably will be relatively tight, at least compared to today. And that spread widens out because the food companies can afford to pay more for canola oil than the biodiesel producers in general. This is just that spread between renewable diesel, or between RBD canola oil and soybean oil. Again, you can see that it kind of has been a little bit all over the place, but was historically low sort of last fall, and we expect it to go up. And then, boy, I guess I'm a little surprised by that. I need to double check this. I'm sorry. The increase I was thinking of comes in 2024. I apologize for that. So I guess for 2023, we get sort of the same increase that sort of mirrors the same path that we see in a lot of the prices, increasing spread through the fall until we harvest the US crop, and then that spread comes down. But then if you look at the rest of 2024, I promise, and sorry for the confusion earlier, you go from that relatively low level up to 12, 13, 14 cents, I think, by the end of 2024. All right, and then this is the futures forecast. Again, similar pattern, less amplitude, I suppose, to the rally. We still think 65 cents generally right now is sort of fair value, but that will vary a little bit depending on, of course, renewable diesel demand and biofuel feedstock demand and all of that. But it will depend a little bit on where soybean futures are. That relationship still exists. If you look at the R squared on that relationship, it's like 0.8 or 0.85 or something like that. And so lower soybean prices will ultimately affect soybean oil prices. And again, if we can get through South America without having to cut the Argentinian crop down to 25 or some crazy number, and then get the US crop planted and get good weather early on for the US crop, then I think you probably will see some pressure on soybean prices and ultimately some pressure on soybean oil prices, even as the demand starts to pick up. And I think that probably will be more reflected in the basis numbers than the increase in demand, more in the basis numbers than it will in soybean oil futures. Soybean oil futures in the US, one level, have to reflect the domestic market because it's a deliverable contract, and so ultimately delivery has to work out in the domestic market. But a lot of people hedge their soybean oil exposure in the US markets, and so there is some world influence on it. And that's why you get sort of the flatter curve there, the flatter forward curve there. All right, I will stop this, and it looks like we've got some questions, which I always appreciate. Um, before I really get into the questions, one other thing that I meant to say before we started is, and I hate when I do this, but it's what happened. Because of the issues I've had with Excel, I am behind on catching up with email. And so if you have an email and you're waiting for a response, I'm really going to try and get to those this afternoon or tomorrow morning and get all caught back up. I apologize. I've just been trying to figure out this Excel issue and figure out how I can work. And given what I've got going on with Excel right now. So again, apologize if I haven't responded to your questions. I will try to get to them as soon as I possibly can. Okay. The EPA announced underwhelming RVOs for the D4 RIN category. How do you see D4 RIN pricing and thus RD margins being affected by this moving forward? So we've already seen RIN prices come down since the announcement. And if you look, RIN prices are most closely correlated with feedstock prices, and so feedstock prices have come down and RIN prices have come down. The feedstock move is in part due to the lower than expected mandates, and the RIN prices, I think at this point, are just following the feedstock prices. Now, for this idea that renewable diesel producers are going to have to overproduce relative to what the mandates imply, I've gone back, I've tried to reconcile the RIN balance sheet, but one of the other things that I did was I looked at, and I wish I had put this slide in here, I'll get it in the shortly. I have a slide that shows the production of D4 relative to what the mandates would have implied for production. So not just the mandate, but the mandate plus the undifferentiated advanced mandate, which is just D3, D5 production shortfalls against the advanced mandate. And then the gap between ethanol production and the ethanol mandate. So if you add all of those in, if you add those to the D4 mandate, what should biomass-based diesel production have been, and what was it? And if you look back through history, most of the time, the industry has overproduced relative to that number. However, over the last 3 years, it's actually underproduced relative to that number. And if that then translates into RINs, which in theory it should, but since some of this stuff gets exported and the RINs go away, or some of the RINs go away for other reasons. But let's just assume that all of that doesn't really matter, and we just look at D4 production relative to what we thought it should be. It doesn't look like we have way overproduced D4 RINs over the last 3 years. And if anything, it looks like we probably are a little bit short over the last 3 years. And a little bit, I mean, it looks to me like we probably, for each of those years, I think call it an average of 200 million gallons short of what we thought they would be. And so that suggests that even if ultimately my theory is right about the overproduction, that the RIN bank probably isn't so just overflowing with extra RINs that that RIN prices will ultimately be impacted just by the production alone, because I think there probably is a tipping point where the supply and demand of RINs actually does come into the pricing. There obviously is, if you think about the shortfall. If you think about a shortfall in production, then RIN prices obviously can go up even if feedstock prices are coming down. But going the other way is always a little bit more difficult, where we overproduce RINs and then you see falling RIN prices. there probably is that level out there someplace, but I don't think we're going to get close to it this year, one way or the other, higher or lower. And so I think that as at least through 2023, it looks to me like D4 RIN prices are just going to be mostly a function of feedstock costs. And so from my perspective, if I'm thinking feedstock costs are going to go up over the next 6 months or 5 months, then I would probably expect RIN prices at least to stabilize and maybe to move higher with feedstock costs. What I would say about the mandates in total is that while the 2023, 24, and 25 biomass-based diesel mandates were all below our expectations, the total renewable fuel mandate was below our expectations in 2023, but then above it for 24 and 25. And that really comes down to how the impact of that on biomass-based diesel production comes down to how many of the new eRINs are they going to generate, and how many people are going to buy cars, and what production is going to be, electric vehicles, and they have really aggressive assumptions about D3 production, which is where the eRINs are going to fall into. We've seen big growth in D3 production over the last couple of years, and I know that there are, well, I'll put it this way: I never used to get any questions at all about biogas or that kind of thing, or renewable natural gas, that kind of thing. And now it's not like I get bombarded with questions about it every day, but I do get questions about it. And so I know that that can still grow, but given the assumptions based on the mandates, or given the assumptions in the mandates for D3 production, it may be that that if we fall short of those assumptions, that biomass-based diesel will again need to sort of fill in. So if D3 production falls short of the D3 mandate, that adds to the undifferentiated advanced mandate, which is just the advanced mandate minus D5 production minus D4 production minus D3 production. Well, when D3 and D5 fall short, then D4 has to make up the difference. And so the one place that looks like it potentially could happen is in D3, just based on the aggressive growth that they have in D3 RIN mandates over the next couple of years, and the assumption that growth kind of continues going forward beyond 2025. And so I think that there is some opportunity, even though the numbers are disappointing on the face. I think there is an opportunity for production to be a little bit stronger than again the mandates would imply. For that reason alone, even if I didn't look at renewable diesel capacity utilization, if I just looked at the growth in D3 production over the last couple of years, and then what they're assuming over the next several years, I think that there's a chance. I don't know that they will be as short as they have been historically relative to cellulosic production, but I do think that there's a chance that it falls a little short. What is the relation of soy crude price between the Gulf and Chicago? So what it really should be most of the time is, or I guess at least the way that I would think about this most of the time, is that the Gulf kind of reflects the world market, and that essentially drives U.S. domestic prices. Now, right now, we're kind of in almost the opposite, where U.S. domestic prices are disconnected from world supply and demand. And so U.S. domestic prices are not going to allow whatever the relationship between the long-term relationship between the Gulf and Chicago to function in the same way. Because usually I would think it was sort of world prices coming through the Gulf into the domestic market, and now it's going to be a little bit of the domestic market flowing out through the Gulf and then just kind of stopping there because the world market isn't in the same spot. And so traditionally, the way that I would have thought about the relationship between central Illinois and the Gulf, and this might not be absolutely correct, but this was the way that I thought about it, is that the Gulf price should essentially be the Chicago price plus logistics. That sounds backward. What I really mean there is that the Gulf price is the world price, which sets the domestic price. And so if you take the Gulf price and then you back out the logistics, then you should be able to get to central Illinois. There'll always be fluctuations around that based on the relative supply and demand in central Illinois to other places. But that kind of should have been the relationship in the longer term. Right now, because of the disconnect, I think that there probably is, whatever the Gulf price is the number that is high enough to discourage anybody from trying to buy soybean oil from the US, and is a little bit of a function of the domestic market and then a little bit of a function of the world market. But the domestic market probably has a little bit more influence, and so that's why you see the spread between the Gulf and Argentina is so wide, and why you see US soybean oil exports just absolutely drop off a cliff at the beginning of this year. It appears that the IRA will cause SAF to attract the low CI fats and greases. How does this affect the feedstock diet for RD? A larger role of soy and RD feedstock mix. Any further thoughts on this? SAF is, I guess, for the portion of SAF that is from renewable diesel, I don't have any disagreement with that argument, I think. However, I think right now, and I think over the next year or two, what you're going to see is that the renewable diesel industry and the ethanol industry are both going to try to make it so that they have they set their market share, or I guess they're both competing for market share right now. And so depending on exactly how that shakes out, how much of SAF production actually comes from ethanol and how much of SAF production actually comes from renewable diesel production, that will have a significant impact on this idea. If the bulk of SAF production comes from ethanol, and we've already seen big crushers commit a significant portion of their ethanol capacity to SAF production, so it's not far-fetched to think that that a significant chunk of SAF production will come from ethanol. In the extreme, that means that there probably wouldn't be much of an impact at all. In the sort of the middle case, I guess, if you just think of the most likely case, what that means is that that let's just say that SAF is split down the middle between renewable diesel and ethanol. What you're going to have is you're going to have a situation where you start to run out of fats and greases one way or the other, whether SAF takes them or renewable diesel takes them. And so you're going to have an increase in ethanol production, or you're going to have an increase in soybean oil used in renewable diesel production one way or the other. If SAF takes a more significant portion of the low CI feedstocks, then I think that that will just exaggerate that. But at the same time, the other thing that it's going to exaggerate is the food versus fuel debate. You're already seeing, Europe and in California consider limits on the amount of biofuel that comes from vegetable oils. And in the real extreme, all of the low CI feedstocks go to SAF, and you're left with biomass-based diesel using soybean oil and canola oil to produce renewable diesel. Then obviously that would be something that would attract further sort of arguments on the food versus fuel debate to try and limit the growth in vegetable oil use in renewable diesel production. I think you could also kind of come at this from a little bit different perspective and say that maybe this will work, maybe this won't, maybe this will be the dumbest thing I say in a while. That if SAF production is so immensely profitable, and let's say that California enacts a ban on or a limit on the amount of biomass-based diesel that can come from vegetable oils, I think you could almost see a situation where biomass-based diesel producers are desperate for those low CI feedstocks, so they're willing to pay more for them. And SAF producers, while they can be marginally more profitable using the low CI feedstocks than soybean oil, and I know that may be a more significant difference than I'm sort of making it out to be right now, but let's just say marginally more profitable using low CI feedstocks than soybean oil. Then I think that you could see a situation where the renewable diesel guys get a lot of the low CI feedstocks, and the SAF producers are okay with using soybean oil, especially if they have done things to lower their CI score. So if you're a Midwestern renewable diesel producer and you have carbon sequestration and you've done other things to lower your CI score, so your CI score isn't 50, it's 30 or 25 or whatever, then if you're using soybean oil, you're still going to get a significant chunk of that IRA credit, and it may be that you're okay with that. I don't know exactly how I think SAF is going to shake out, because again, I don't know. All I know right now for sure is that both the ethanol industry and the biomass-based diesel industry are going to compete pretty vigorously for market share over the next couple of years. And I think that that the ethanol producers are in some sense in the same spot as some of the biodiesel producers, where as we go to a larger percentage of the auto fleet is electric vehicles, that reduces the demand for ethanol. And so they're looking for, how do we survive beyond that point? And they will do obviously whatever they need to do to survive that. And so I think that while any business that can is going to absolutely maximize profits, that it may be for ethanol producers that they're happy to operate at sort of the lower profitability as long as they can survive. And that may mean that that they're much more competitive for SAF, and the impact of SAF on renewable diesel is lower. Now, if we're going to produce 33 billion gallons of SAF by 2030, and we're going to produce whatever we need for trucks and trains and ships from the renewable or the biomass-based diesel industry at that point, it may be that we just don't have enough feedstocks, and there's plenty of credit and profitability kind of for everybody. But I don't think that I will have a really great handle on this question until I have a much firmer grasp on how much of the SAF production is going to come from ethanol and how much of it's going to come from renewable diesel. You mentioned that you would be updating the fats and oils forecast. Can you provide some commentary on the forecast for UCO and yellow grease? I can, if you'll bear with me here just 1 second and see if I can get this file to open and then, more importantly, update. Sorry to look off like that. So again, what I would say in general is that what we've seen over the last week, or maybe a little bit more than that, is we've seen a sharp move lower in fats and in grease prices. And if we look at the move in yellow grease and UCO, they both dropped like a rock through September 11th, and then September 11th. Through the 13th of February, and then they both have kind of stabilized around that price, which was around, for the Illinois market, was 47, 48 cents, somewhere in there. Used cooking oil was a penny premium, so 48 cents for used cooking oil. A little bit less today, 47.5 versus 48 for yesterday. And then going forward, what we have is we have prices going up a little bit in March for both, although it looks to me, well, that's a Los Angeles price. It looks like, I would say that if you're looking at the website right now, it's an old forecast, and so the used cooking oil price is significantly above the yellow grease price. Now, in the California market, that may actually be true. Sorry, I just haven't been able to kind of go through the stuff that I normally do, and so I'm doing this a bit on the fly. In the California market, yellow grease is 47.5 cents, or 45.5 cents, actually below the Chicago market. And used cooking oil is 48.5 cents. So it's a 3-cent spread, not a 11-cent spread or whatever is in this forecast. So what I would say is that I think the yellow grease forecast, which, just so you can know, for March, I have it at sort of just over 51 cents. And then in April, I've got it going up to 57 cents, and then kind of between 57 and 58 for most of the summer, and then up above 60 in the last quarter of 2023. That forecast for yellow grease is the UCO forecast will probably mirror that forecast relatively closely. we've seen the profitability for most feedstocks decline in the last month or so. For UCO, it looks like the decline was a little bit larger than for some of the other feedstocks, but that was, again, and I apologize for this, based on sort of a couple weeks worth, a couple weeks ago, data from a couple weeks ago. I suspect that now, given what I've just seen in the prices here, that UCO is probably continued to come down a little bit more sharply than some of the other feedstocks. And ultimately, unless there is a significant reduction in supply, and this kind of gets back to the what I was talking about earlier in the non-biofuel demand, unless there's a significant reduction in UCO supply because people aren't spending as much money on food, then I think that the UCO forecast probably looks very similar to the yellow grease forecast. Now, traditionally, that spread has been relatively wide, so 9, 10, 11 cents. And it looks like in the collapse in those prices in the first couple of weeks of December or February, wow, that that price is narrowed to an historically low level. And while it probably stays there in the short term, that spread is something that I would look at as a indicator of when we will ultimately work through the backlog of fats and greases at the biomass-based diesel producers. Once that spread starts to widen out again, then I think you can confidently say that we've sort of worked through that backlog, and now we're starting to sort of match up the supply with the demand. And at that point, I would assume that the spread would start to widen, and UCO prices would rise more quickly than yellow grease. Now, it could be that the increase that I have, let's say in sort of April, so the big sort of 5-6 cent jump, that is less reflected in yellow grease and more reflected in UCO. And in fact, in that period, I only have UCO up a couple of cents because the spread is wider in my forecast. And so I would say that it would probably be the opposite of what I'm going to forecast. What I will do is next week, I will talk a little bit more about UCO and yellow grease and what I think is going on in those markets. And the other thing that I will do is I will send you an email after I get done adjusting the price forecast, so you can see where I end up, because unfortunately, you're not going to see it on the website today. Okay, that is it for this week. Again, I really appreciate your patience over these last couple of weeks. I know it's not ideal. I'm trying to get things fixed and back together as quickly as I possibly can. And again, hopefully for next week, we'll be all back together and everything will be running smoothly. Thanks so much for attending. And as always, have a great week. And I hope to see you back here next week.